best dividend growth stocks with fast growing dividends for long-term wealth in 2024. As always, we'll look at the historical performance of each stock. We'll run through their dividend safety, we'll look at some of their financial metrics, and we'll run them through the valuation model, getting to the intrinsic value as well as the acceptable buy price, given that investor margin of safety, and look towards Wall Street to see what they forecast over the next 12 months. Starting off with stock number 1, we have Visa Incorporated. Now this is up over 23% over the last year, currently trading towards the upper end of the 52-week range with a forward yield of 0.75%, a forward PE of 27.88, and if is this one of the companies you have been holding over the last 10 years, you would be up 389%. Bear in mind it doesn't include those dividends reinvested. So let's take a look. Dividend safety score 99, very safe, the highest score obtainable. Market cap 555 billion, a mega cap company. Now for those that see a recession inbound, they did in fact increase the dividend during the last recession 07-09 and had above average growth 9.5% versus the S&P's negative 12. Dividend growth 16% increase last October, 16% increase over the last 5 years. And over the last 10 years, 18% every single year. They are definitely a fast-growing dividend company. They've also been increasing those dividends for the last 15 years consecutively. And when we take a look at dividend yield theory, which states a company is undervalued when the current yield sits above the 5-year average, we have our first signal here, as well as another signal with the forward PE 26.9 versus 29.2. But do keep in mind we don't look at any of these models in isolation, and we will conclude towards the end. We also note the financial sector PE is much lower at 11.2. Now, in terms of the payout ratio, regular viewers know we skip the earnings. Whilst it is available here for investors, we personally ignore it as it is susceptible to manipulation by management through accounting. Below 60% is our preference on the free cash flow payout. As Visa always do, we believe below 60% means management can offer those double-digit dividend increases. Consistently around that 20% or lower for the majority of the last 10 years, 19% in 2023, 21% in 2024. Free cash flow per share, very nice to see. It has increased significantly over the last 10 years. And whilst it isn't consistent increases year on year, it is some strong growth over the long-term horizon. 2024 again expected to be an increase from the previous year, 1010 versus 962. Sales growth, nearly double-digit increases to the top line every single year. We note the COVID drop of negative 5%, 2023 11%, very strong. And when we look at it numerically, we can see the top line has nearly tripled from 13 billion in 2014 to 33 in 2023. On top of that, they do return a lot of excess cash to investor pockets through share buybacks, 2.52 billion in 2014, 2.07 in the latest quarterly report. ROIC, return on invested capital, it is one of my 7 golden dividend metrics. As always, I want to see at least 10% as part of my investment thesis. It is what I look at when analysing management. The higher this percentage or above 10%, the better faith I have. And we can see a strong 34% in 2023. Margins are never an issue with Visa, consistently very, very strong. 67% over the last 2 years, absolutely incredible. And the same can be said for the free cash flow margin, an absolute free cash flow machine in the low 60s over the last 3 years. On top of that, the net debt to EBITDA, which is earnings before interest, tax, depreciation, amortization, shows us 2 things. First, the balance sheet strength. Secondly, the dividend safety. We want to see below 3 for most companies, and this effectively shows the number of years it would take them to pay all of their debt net of cash on hand. 0.05 for Visa, we can see absolutely incredible. No issues with the dividend safety and no issues with their balance sheet strength. So let's jump into the valuation, and as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Typically on the channel, when we do deep dives, we do run into all of these different models. Today's episode, let's get straight into the intrinsic value, and for today's episode, it comes out for Visa at $308. Now, the current trading price at $27165, we start off with a margin of safety of 10%. Which we typically use if we believe it meets 3 criteria: wide moat, strong financial metrics, good forward-looking data. We can see for Visa, we see at least 10% margin of safety up to 277. When we move this to 15%, we can see it's not quite there yet. So right now for Visa, based on our estimates and judgments, we have a margin of safety of 10%. In terms of Wall Street, well, their expectation over the next 12 months is a price target of $304, and they see upside of 12%. Now, as we go through these stocks, they're not all necessarily significantly undervalued right now, but these are one that we do believe should be added to the watch list as a bare minimum due to their very strong financial metrics. Do let us know as we go through these companies whether or not you have been adding any or whether they are on your watch list. Moving on to stock number 2, we have Lowe's company. Over the last year, they are up 6.5%. They're trading in the mid to upper end of the 52-week range with a yield just shy of 2%, a forward PE of 17. And over the last 10 years, you would be up a strong 370%, although we do know their all-time high is sitting around that $261 mark at the back end of 2021. Dividend safety, another very safe score of 93. Market cap, 128 billion. They are a mega cap company. Recessionary metrics, well, they increased the dividend in 07-09, above average growth, and they had a near S&P recession return. Dividend growth, now the latest increase wasn't the greatest at 4.8%. Yes, it is above the inflation of 4% that we advocate on the channel, but given how over the last 5 years and the last 20 years there have been some strong double-digit increases, we would have expected more. Nonetheless, we do hope we see those double-digit increases in the future. They are also a dividend king. They have increased those dividends for 50 years or more. Absolutely incredible. And when we take a look at dividend yield theory, we do see some reasonable valuation. 1.98 versus the 5-year average of 1.88, and a forward PE pretty much in line with the 5-year average. Comparing it to the consumer discretionary PE of 14.7, Lowe's does sit slightly higher. Free cash flow payout for the large part pretty strong, below 60% continuously. 37% in 2023, 37% again expected in 2024. No issues to note. Free cash flow per share has also been increasing more than 3 times over the last 10 years, but again, we do see the inconsistencies. Nonetheless, if you do hold these companies for a long time based on the historical performance, they do have some strong growth. 2024 expected to be an increase from 2023. Sales growth, again, we can see some strong increases year on year, at least at 3 to 7% for steady moderate growth, although we do note 2023 was a fairly poor year, only up 1%. Total sales, 53 billion in 2014, 97 in 2023, nearly doubled their top line over the period. And what's very, very strong with Lowe's, they do a significant amount of share buybacks, very aggressive, 1.06 billion in 2014, 591 expected or from their latest annual report. Then we look at the ROIC. Not only is it above 10%, the minimum we like to see, it has also been increasing with 51% in 2023. Absolutely incredible. It is a very strong metric for Lowe's. Margins, now it isn't around that 12% we want to see consistently, but on the more positive side, it has been increasing with the last 2 years at 13%. This is one that I would like to keep an eye on and hope it does continue to be around that rate. Free cash flow margin then, above that 5% minimum we like to see, although again, very inconsistent, so maybe one to keep on the radar. In terms of the debt levels, it has been increasing, unfortunately, 2.29 in 2023, expected to go higher in 2024. One thing just to keep an eye on, although we can say it is still below that 3 maximum we like to see. So let's jump into the valuation for Lowe's. As always, if you do want to grab a copy of the valuation model, you can click on the pinned comment below to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those on your watch list. So margin of safety of 10%, we can see it is pretty much under $1 difference from the current trading price. So for Lowe's, we see around a 10% margin of safety. In terms of Wall Street, over the next 12 months, they see 10% upside with a price target of $245. Now, before we jump to the next stock, just to let you know, we have released our latest newsletter on discussing insider buys and sells over the last few weeks. If you want to grab a copy completely free, click on the pinned comment below. We send out weekly newsletters, the latest one. We also have some on undervalued companies with strong upsides, as well as talking about our 7 golden dividend metrics and screeners to find these undervalued companies. The next stock for fast-growing dividends, we have Avgo Broadcom. No list would be complete without this company. Now, yes, over the last year, up 114%. Over the last 10 years, up 2,110%. Absolutely incredible. And when we take a look, they are at the 52-week high. They do have a yield of 1.64% and a forward PE of 27.41. As we mentioned before, these aren't necessarily all undervalued companies, but they should definitely be on the watch list. And we do run through the margin of safety we do see with each of these companies so far. Dividend safety score then 67, it is safe. Market cap 601 billion, it is a mega cap company. When we take a look at the recessionary metrics, well, they had around average growth during the period of negative 12%. Dividend growth, absolutely incredible, 14% just in December 23, 19% over the last 5 years. And if you've been holding this over the last 10 years, not only would you see that incredible share price return, but you would have also had your dividends increase 36% year on year. In terms of dividend growth streaks, they have been increasing those dividends for the last 13 years. We then look to dividend yield theory. We can see we have a sign of overvaluation with the current yield above the 5-year average. Likewise, the forward PE sitting above the 5-year average of 14.9. And we can see the information technology sector 26.8, only marginally lower than that of Broadcom currently. In terms of free cash flow payout, below 50% if you want to be more specific for the semiconductor industry, and Broadcom has been below that year on year. 2023, 45%, 2024 expected to go even lower, so no surprises, we should expect to see a nice double-digit dividend increase in 2024. Free cash flow per share, probably one of the few that you will see on the channel that we analyze that consistently increases it year on year. 2024 expected to go even higher. Very, very strong sign of a company when they are consistently increasing that free cash flow per share. Sales growth, they've had some very strong double-digit increases over the last 10 years. 2022 at 21%, 2023 at 8%, still looking very strong. And numerically, we can see their top line has increased from 4.3 billion in 2014 to 36 billion in 2023. Now, unfortunately, they don't do share buybacks or haven't done a massive amount. In fact, they would have diluted your position over the last 10 years from 267 million shares to 427. Moving on to the ROIC, nice to see the last few years in double digits, but this hasn't always been the case. Nonetheless, in the more recent period, it is looking very strong. We then get to the margins, both operating margin and free cash flow margin, very strong and in fact increasing over the last 10 years, showing some nice operational efficiency gains. Net debt to EBITDA then 1.1 in 2023, expected to go below that in 2024. No worries here with the balance sheet, no worries with that dividend safety based on the information we have currently. So let's get into the valuation for Broadcom. Now for today's episode, the intrinsic value is coming to $1,257. And what we can see, that is pretty much around the current trading price. So we believe that Broadcom is trading around its intrinsic value with a 0% margin of safety. In terms of Wall Street, well, their price forecast sees upside of around 3% and a price target of $1,325 over the next 12 months. Moving on to the next stock. Now, this is one that is right up there on my watch list. It is Old Dominion Freight Line. I do like this one a lot. It is up 23% over the last year, and over the last 10 years, up 1,110%. It is trading towards the upper end of the 52-week range with a yield of 0.48% and a forward PE of 34. Dividend safety, very safe at 81. Market cap, 47.5 billion, a large cap company. Key metrics, well, negative 19% during the recession and negative 22% outperforming the S&P. Dividend growth, incredible 30% increase last month, 36% on average over the last 5 years. And we can see they have been increasing those dividends for the last 6 years. Absolutely incredible. Strong increases in conjunction with their share price increase. We also see a sign of undervaluation on the yield, 0.48 versus 0.40, but we do note the forward PE does sit higher than the current 5-year average. Although when we do compare it to the sector PE, industrials is much lower at 19.5. So let's look at the payout ratio so we can see where they do offer that very high double-digit increases. 15% in 2022, 29% expected in 2023, 23% expected in 2024. Free cash flow per share increased insurmountably from 19 cents in 2014 to 8.16 in 2022. 2023 at $9, looking very strong for this behemoth of a company. Sales growth, very unfortunate to see, -6% in 2023. Otherwise, over the longer term, they are increasing their top line at a strong rate. And we can see that when looking numerically from 2.8 billion in 2014 to 5.9 in 2023. They also do share buybacks, again, not massively, but have reduced it from 129 to 110. So ROIC, very important metric. Not only is it very strong over the last few years, but it has been increasing. This is what I love to see when it's above the minimum and it is increasing. Lots to like there. Same can be said for both margins, operating and free cash flow, above the minimums and also increasing 28% in 2023, 15% in 2022, and expected 10% in 2023. Net debt to EBITDA, fantastic. Look at that. Their balance sheet, very strong. It wouldn't even take them one day to pay off all of their debt net of cash on hand. So let's get to the important part, which is the valuation. We may be identifying some high quality companies, but it all comes down to the intrinsic value and the acceptable buy price. Intrinsic value coming to $460. So we can see here then the current price at $435. If we start off with a margin of safety at 10%, we can see it isn't quite there yet. And at 5%, it is pretty much bang on. So it has a margin of safety of 5% based on the current value. In terms of Wall Street, well, they see no real upside to the intrinsic value at 434. And as we have seen through this essential analysis, this is one that I definitely will be adding to the portfolio, but I am waiting for a much higher margin of safety. As always, though, do let me know your thoughts in the comments below. The next one we're looking at is Cintas Corporation. Again, very strong, up 40% over the last year. Over the last 10 years, up 957%. Again, trading towards the upper end of the 52-week range. A yield of below 1%, a forward PE of 42. Dividend safety score 97, very safe. Market cap 63 billion, large cap company. They increased the dividend during the last recession, average growth for the period, and also beat the S&P, although marginally negative 49%. A 17% increase to the dividend last summer, 23% on average over the last 5 years, and a strong 15% on average over the 20-year period. In terms of dividend growth streaks, well, they are a dividend aristocrat, increasing the dividends for the last 25 years or more, and around 9 years away from becoming a dividend king. In terms of dividend yield theory, you could argue reasonable valuation, 0.87 versus 0.95, although we do note the forward PE is higher than the 5-year average, 40 versus 34. And when we compare it to the industrials of 19.5, Cintas does sit much, much higher. So let's take a look at the free cash flow payout, below 60% continuously, 37 in 2023, 35 expected in 2024. So again, double-digit growth should be expected from this company this year. On top of that, free cash flow per share has increased over the last 10 years, 382 to 12.5, expected 15.3 in 2024. Sales growth, double-digit increase for the vast majority of the last 10 years. Last 2 years looking very strong as well, 12% in the more recent period. In terms of their top line, more than doubled from 4.2 billion to 8.82, and very, very strong for this company. They also do share buybacks, although again, you could argue it isn't as aggressive as maybe you would like, 122 to 103. Let's look at the ROIC. Again, very strong, consistently above 10, and we can see it has been increasing, 26% in 2023, the highest of the last 10 years. Always a strong sign when it's consistent and increasing. No worries with the operating margin, above the minimum 12%, again increasing, looking very strong. And free cash flow margin, nothing to note here, no worries. And what I would say as we are going through these metrics, especially for these very strong companies, always make a list of any of these metrics that you think are very good and analyze them when you're looking at other companies to see how they compare. Net debt to EBITDA 1.12 in 2023, expected 106 in 2024. Again, no real worries so far based on the balance sheet or that dividend safety. So what about the valuation of this strong company? So for today's episode, the intrinsic value is coming to $689. Don't forget as well, you can run your own companies through the valuation model to get your own intrinsic value and acceptable buy price of companies in your portfolio by clicking on that pinned comment below. So margin of safety at 10%, it is a buy pretty much at the current trading price, so we see around a 10% margin of safety. In terms of Wall Street and their expectations, well, they have a price target of $660, upside of 7% as well. As always, as I mentioned, this isn't essentially running through undervalued companies. We're looking at fast-growing companies, increasing their dividends. And what you should also note with these companies is that their share price also increase. Now, you may be looking for very big discounts, and if we ever do come across those, we will be dropping those videos on the channel. But what we wanted to highlight today are these strong companies have a lot in common in terms of their metrics, very strong ROICs, very strong margins across the border, relatively low debt as well to EBITDA. So a lot of things you should take on board when you're looking at other companies that we may not necessarily cover on the channel. As always though, do let me know your thoughts. If you enjoyed today's episode, smash that like button. I'll see you on the next one, and for now, take care.